Lululemon is down more than 50%. That is just year to date and now trades right there towards its 52-week lows. But is it an undervalued buy after some very big news? Now, as you know, when we do our analysis on this channel, we typically like to look at insider buys and sells. Now, the current ownership is very small. It sits around 0.48%, and we have noted around 21 million worth of insider selling over the last year. However, we have some news now around 1.31 million worth of buys over the last year. And why this is important, because on this channel we always say insider buying, very bullish signal, management buy because they believe the company's share price will rise. And when we look at the more recent quarter, that is where we see the buying of over 1 million. And for full transparency, we want to run through who this is. In fact, we note this is just last week. Calvin McDonald, who is the CEO of the company, bought 4,000 shares for the rough price of $260. That is $1 million worth. Now remember, we do see this as a bullish signal. We also know there has been insider selling over the last 12 months, but as always, we don't consider this to be a bearish signal. Remember, insider sell for many reasons, personal and financial. However, we do note insider buying as a very bullish signal. So let's have a look, see whether or not we believe now is a great time to add alongside the CEO. As we mentioned, year to date, very poor performance, down 52%. When we do extend it though, over the last 10 years, they are still up 475% and have significantly outperformed the S&P during this time. As we mentioned, right there towards its 52-week lows, currently has a forward P of around 17.7, with both a buy signal from Seeking Alpha and Wall Street, although we do get that very common hold from Quant. Now, in terms of how they performed just in their latest earnings, we do note in a comparison versus the same quarter last year, the revenue is up mid to high single digit at 7%. We get EPS up around 18% with comparable sales around 3%. Now, one of the things we did want to highlight from this, when we do take a look at their expansion, it is very minimal in the Americas. We see plus 1%. However, international revenue is what this company is trying to do in terms of driving that growth, plus 29%. Now, we're going to look at the exact financial metrics of this company to understand whether or not we deem it initially to be a high quality company, as well as projections over the next 12 months. Now, starting off with the free cash flow per share, as always, consistent long-term growth is what we want to see. Now, it has grown rapidly from $1.35 to $13 in 2024. We also see the expectation is for this to continue $14.10 over the next 12 months, so a good sign that management are expecting this continued growth to go the right way. In terms of the sales growth, well, looking very inconsistent in terms of the actual movement. However, what we do like is every single year has been double digits, although it has started to lower from the highs of 2022 down to 19% and 13% as we can see here on a trailing 12-month basis. As we just mentioned though, from the same quarter last year, their revenue is up around 7%. Now, from a numerical perspective, what we can see, it has increased quite significantly, in fact nearly 5 times, from the 2015 position of 1.8 billion to just under 10 billion in 2024. Now, they don't have a large amount of shares outstanding, but we do know they have done some share buybacks going from 144 to 126. Always great, essentially returning excess cash to investor pockets by giving them a larger portion of control of the company. And in terms of ROIC, one of my favorite metrics to look at high quality companies, 10% or more, give us that faith that management are able to effectively allocate their capital, consistently looking very strong. And what I quite like about it, not just above the minimum 10%, but it is around the 30 to 40% region nearly every single year, 39 in 2024, 42 over the last 12 months, and that will make it incredibly attractive for investors to consider. Then we move on to the margins. Now, what we're looking for here, not just above the minimums of around 16%, but ideally we want to see some efficiencies with increases to the margin year on year. We do see it very inconsistent, although up from 21% in 2015 to 23% in 2024. Free cash flow margin, whilst fairly inconsistent, still above the 5% minimums, 17% in 2024. Then we move on to the net debt to EBITDA. This metric refers to the earnings before the interest, tax, depreciation, amortization, and the numbers that you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. Remember, correlates to the balance sheet strength and we note 0 over the last 5 years, 0 over the next 12 months, so indicating to us they have a very, very strong balance sheet, which we will also take a very quick look at shortly. Now, the other thing we look at, not just insider movement, but also the institutions. Now, this sits around 85%, with around 5 billion worth of selling over the last year, and during the same period, as we can see, more buying, in fact, nearly double at around 7.3. Now, in terms of the more recent quarter, Q2, we see a lot more buying than selling of 2.1 billion versus 444. So institutions clearly do like it at this suppressed price point. However, as always, we never copy what institutions or insiders do. Even if we do see some notable insider buying, we always have to do our own due diligence and make sure it fits within our own portfolio and investment thesis. Now, we also want to let you know we have released our latest weekly articles. If you want access to this or any others, you can grab a copy by clicking on the pinned comment below. We have also released our 25 undervalued stocks for the month of September, where we also run through the upside and whether or not each one currently sits within our portfolio. So do sign up and check that out below. Continuing the analysis, then we just want to touch upon not the top line revenue as we've already discussed, but more importantly their bottom line. As we said, top line revenue increasing pretty much double digit every single year, looking very healthy, moving in that right direction and expected to continue over the next year. In terms of their bottom line, it does tell a very similar story, as we can see, although a little bit inconsistent over the longer term, moving in the right direction, going from 239 million in 2015 to 1.6 billion in 2024. So both top line and bottom line increasing over the period, maybe something that you think should be normal. However, not a lot of companies have that trend. Some, whilst increasing their top line revenue, do find it very difficult to increase their bottom line at a very similar pattern. So already off to a fairly decent start. The second thing we wanted to show, more in fact reinforce that they have a very strong balance sheet, comparing their total cash to their total debt. 665 million of cash in 2015, 1.6 billion in their latest quarterly report. So over the longer term, cash has been increasing, but do remember any one item isn't really going to tell us much about the company, which is why we do compare it to their total debt numerically and directionally, which we can see has been 0 in 2015 and around 1.46 billion in that latest report. So overall, balance sheet does look very healthy. Their cash position not too dissimilar from their total debt, hence why we did see that 0 when we looked at the net debt to EBITDA. We then want to take a look at how they've performed on their earnings versus analyst targets and expectations moving forwards. Well, over the last 4 quarters, they have beaten every single time, so a 100% track record. And what is also very nice to note, over the last 4 quarters, they have been fairly strong beats as well. Over the next 4, what we can see, they're anticipating mid to high single digit growth on the EPS, and if they do hit that 15.06 for January 2026, it will bring that forward P down to around 16.41. Now let's move on to some gradings. The first one is the valuation as well as the underlying metrics. As we mentioned already, the forward P on a non-GAAP basis around 17.8. That is marginally higher than the sector median of 15.5, essentially telling you if you are buying this company right now, you are paying a small premium of 14% against the sector, and that is pretty much what we can analyze through the different valuation methods. No matter which one you use, the majority are telling us that Lululemon is trading at a bit of a premium. Sometimes though, it is warranted why these companies do. Maybe they are a lot better in terms of the quality, in terms of growth, in terms of profitability. Now we do get a C on the growth grade. However, when we look at the year-on-year growth, 13% versus the sector of 2, so that is a good start. Revenue growth forward looking 11.6 versus the sector 3.6, another positive metric. However, the thing that we do see that determines that C rating is the fact that the earnings per share over the next 3 to 5 years is anticipated to grow at 10.5%, which is pretty much there or thereabouts of the sector median. So something just to bear in mind, especially when we do come to look at the margin of safety. Now, the final grading that we have today is their profitability, which we do see sit at an A. Very nice to note, gross margin looking very healthy, 59% versus the sector 37%. Bottom line as well, 16.3% versus the sector median of 4.5%. And finally, when we compare their cash from operations of 2.3 billion, that is significantly higher then the sector of 276, so no surprises, profitability gets an A. So for a quick conclusion for this part of the analysis, a double buy from Seeking Alpha and Wall Street, a hold from Quant, a D+ on the valuation, a C on the growth with an A on profitability. Now we also want to note how they compare in terms of performance against others in the industry. We have Kering, Adidas, Ralph Lauren, as well as some other well-known names. Now in terms of over the last year, we do note it is down 38%. What we can actually see, half of the competitors or half of the population we have has in fact had negative return, so it isn't just isolated to this company. We do see this pretty much across the sector. And then when we look over the last 5 years, we do actually note they are pretty much in the middle right there, around 28%. When we expanded over the last 10 years, they are in fact the best performing, up 472%. Now, whether or not you think this is a very strong performance, do bear in mind that the past performance is not an indicator of future performance. Now let's jump into the valuation model, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $368, how we got to this price, we ran it through the DCF model, and as we can see, we have updated this for the new free cash flow 2024. Now, average growth rate over the last 10 years is around 62%. We've gone very conservative in today's episode, as we can see by looking at their report. Their top line revenue has started to slow down from the last few years, as well as just in the more recent quarter, looking at single digits. So we have a low, medium and high, 6, 8 and 10%. We've gone for 8%, the middle rate with the discount rate. We then get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see, that intrinsic value ultimately giving us 48% upside. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, where you can run your own numbers, whether it's for Lululemon or any others that you do desire. Now, just for transparency, we will show you the 6% for those that want to be even more conservative, coming to $319, indicating 28% upside. And for those that believe it should be a lot more optimistic, well, at the 10% level, we get the 424, which indicates around 71%. Now we're going to be conservative and go for the middle rate at that 8% figure and take it through to the final calculation. Now remember, on this channel we always use a margin of safety, which we do start off with the 10% figure, and we execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now if you believe that Lululemon is a buy up to $331, then we keep going till it's near the current trading price, and what we can see in today's episode, there is a fair amount of MOS. You're getting at least 30% up to $257, and for those that want to see 35% would be around $239. So you could argue sitting somewhere between the 30-35% in today's episode. With Wall Street, as we can see, still fairly bullish on the company. They see some nice upside of 31%. Their price target over the next 12 months, 326. As always though, do give us your thoughts on Lululemon. Is this one that maybe you've started to add dollar cost average into your portfolio? Maybe this is one that you sold not too long ago, perhaps considering to add to the portfolio. But as always, do give us your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe button, and also don't forget to sign up to the free weekly newsletter. And if you want, come and join us in the Patreon, where we do discuss our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.